Thank you for having us. This is joint work with Martin. So this is a picture to motivate what we're doing. On the left-hand side, what you see is dollar payments for assets. This is the red colored areas, is dollar payments for assets. This is government securities, treasuries, muni bonds, and here's equities and mutual funds shares. And you see that these are large numbers. They're $1 trillion of payments that people make to trade these assets. And then there's a small blue sliver, which is associated with payments that people make for goods purchases. And this is multiple times GDP. It looks small in this picture, but it is actually big. It's multiple times GDP because any good travels from the producer up to where it gets sold to Walmart. So all the commerce is being counted in here. So these are payments by people like you and me, that we call end users, people who trade assets and people who want to purchase goods. On the right-hand side is how banks deal with the payment instructions that we make to them, because we use things like our deposit accounts or credit cards to pay for these things. And on the right-hand side, you see how banks transfer reserves to each other to handle these payments. And here, this is color matched. This is color matched. So you see, again, a blue sliver down here that corresponds to payments that banks make to each other, corresponding to goods payments. And then there's other payments that are associated with these asset payments. And so there are several points that I would like you to take away from this graph. One is, this looks like a ton of payments have to do with asset purchases, and you might think, well, they don't matter because they net out to a small number or nothing. And the idea here on the right-hand side is that they don't net out to nothing. Instead, banks still have to make transfers to each other to handle these payments. The same is true for goods payments. This looks small, but it still survives. There's a fairly substantial fraction of payments that banks have to make to each other that have to do with goods payments. And then there are other colors here, like the green area, which is interbank borrowing and lending, the Fed funds market. And you can already see that after the financial crisis, there is not much of a Fed funds market left. So the green area shrinks. And then there's a green area, a gray area that is hard to assign to any reason on the left-hand side. So the big takeaways here is asset payments don't net out to nothing. They lead to substantial interbank payments for both, and they're payments for good purchases and asset purchases. And so this picture motivates us to think about payments in two layers. So the model that I'm going to show you has two layers. There's one layer at which end users make payments to each other. These are households and institutional traders, and they pay for goods and assets. Imagine the payment instruments that they're using are modern equivalents of inside money. It's not just the traditional deposit account that you have at the bank, but you have money market mutual fund shares, you have a credit card, credit lines more generally that firms use to make payments. And then there's a separate layer at which banks handle the payment instructions that they're receiving from these end users. So they have to somehow deal with these payment instructions. And so the way they deal with it is they make interbank payments to each other with outside money. So this is reserves. In providing this inside money to their end users, banks have to deal with two issues. One is liquidity management. They have to decide whether to hold reserves or whether to rely on interbank credit, basically borrow the reserve from a different bank. And they have to decide on their capital structure, which means that they have to trade off the liquidity benefit that is associated with the inside money they provide with leverage costs that they face. And these leverage costs are going to depend on both the quantity and the quality of bank assets that they own. There's going to be a government that issue reserves, the outside money, and other debt. And the government is also going to face leverage costs. And it sets interest on reserves. That's a policy variable. And it trades in all assets. Think about QE. The questions we want to address in this simple setup is how does monetary policy affect asset and goods prices? And how do asset markets and this payment system interact with each other? Those are the questions we want to ask. So let me preview the implications that a model with these two new features. One is this layered payment system where money is a medium of exchange. And asset trading, what they're going to give us. So first, there's going to be a cost of liquidity. And this cost of liquidity will be 0. So it's the difference between an interest rate on a short bond and the interest on reserve. This spread between these two interest rates represents the cost of liquidity for banks. And that will be 0 if there's tons of reserves in the system. Basically, if there are abundant reserves, the interest rate on bonds will collapse down to the interest rate on deposits. And so for banks, that means a 0 cost of liquidity. But the cost of liquidity will never be 0 at the end user level, because the cost of having a deposit account or inside money is always going to depend on bank leverage costs, and that will always be positive. The one message of the model is going to be that policy transmission depends on financial structure. In particular, if you think about setting or changing the interest rate on the reserves, it's going to matter for the policy transmission mechanism how many assets or to which extent assets are exposed to inflation. And in terms of asset trades, it will matter what tools banks have to manage their liquidity, so how much netting there is in the system. In terms of thinking about optimal policy, monetary policy, it will trade off leverage costs by banks in providing inside money with leverage costs that the government has. So this leads to an easy solution. If you think that government debt is cheap, then a system with abundant reserve is going to be optimal. So you just flood the banking system with reserves, as long as that is cheap. But this is also government leverage, so to the extent that this is costly, this may not be optimal. Having asset trading in the model that is done by institutional investors is going to create money demand, because these institutional investors will also need to hold inside money to make these asset trades. In particular, there's going to be a transmission from variations in asset values to the price level. That goes in two ways. One is it will affect the supply of money. So bank assets, for example, suppose that asset values decline, then the value of bank assets declines. That means the money multiplier is going to go down, because banks will not have many assets to easily create inside money. And that's going to be deflationary in this model. And on the other hand, if asset values decline, then institutional investors are going to have a lower demand for inside money. And that's going to affect velocity in the goods market, and that's going to be inflationary. So you see that these are two opposite forces that are at work. In particular, this force through money demand is new in the setup. How does monetary policy affect real asset prices? If asset purchases by the central bank make asset values assets more scarce that banks hold, that's going to push up prices. And on the other hand, if asset purchases can increase the cost of liquidity of banks, and that's going to be deflationary. So you'll see all these things coming up in the setup. So this was just a preview of what you're going to see. Here's a schematic overview of this model. So you have households, and the households can hold assets. They can hold trees and government debt. or they can hold these trees indirectly by holding equity or deposits of banks who can then invest in these assets. The blue arrow means this is an asset that provides liquidity services to households, and banks can hold reserves, and reserves also provide liquidity services to banks. And banks can borrow and lend to each other, and that also provides liquidity. So this is the version that I'm going to show you first. We're going to make a bunch of simplifying assumptions to to make this model stark so that you can see the results most cleanly. In particular, I'm going to assume that output is constant. So aggregate output is constant. And part of this output comes in form of dividends of assets that banks can hold. Households here are infinitely lived. They have linear utility, and they discount the future at a rate delta. Households can invest in the trees. They can hold deposits with their banks. They can hold short bonds or bank equity. The key assumption is they cannot hold reserves. These are assets that only the banks can hold. And that's going to be our numeraire. And they cannot short these assets. These households have a demand for payment instruments. And that demand is modeled through a deposit in advance constraint. So their goods purchases are going to be lower or equal to the amount of deposits that they have. And so again, I'm going to use the word deposit, but think more generally, this includes credit cards, money market mutual funds. It's a modern payment instrument, and there's no currency in this model. So it's really a modern economy without bills and coins. Alternatively, we could have assumed here a money in the utility function. So this is just one way of doing it strictly so that the effects are going to be very clear. The interest rate on these deposits are going to be low enough that households don't really want to hold deposits. And so this constraint is going to bind in equilibrium. Prices are flexible. So goods prices here are completely flexible. That's another assumption that is not something that we believe strongly in, but it's something that is going to drive home the effects that we want to illustrate. And there are many competitive banks. They're held by the households, and they maximize shareholder value. So the households here own the banks, they own equity in the banks, and the banks maximize shareholder value. And these banks are big banks. So they're not, these are not entrepreneurs that are running the bank. They're firms that maximize shareholder value, and they can costlessly adjust equity. So they can issue equity. Let me talk more about the problem that the banks are solving. Any question here? So you can feel free to interrupt. There's a central bank, there's a government that is going to issue these reserves, and the banks will be the only ones in this model that can hold these reserves. Exactly. No. These banks I'm going to show you will want to hold these reserves by themselves. So I will get there. Liquidity management will want them, will generate a motive for banks to hold reserves. Okay, so this is the balance sheet of banks, of a typical bank. The bank holds reserves. It can lend to other banks, that's Fed funds lending. It can hold government bonds or invest in trees that banks have access to. So there's going to be different trees, and banks have access to a subset of these trees. And QB is the price of a bank tree. We're going to determine this later. On the liability side, they issue deposits. They can borrow from other banks, and they issue equity. And this is something that the households hold. So how does their cash flow look like? So they're going to maximize shareholder value, which is the present discounted value of future cash flows. How does the cash flow look like? It's basically changes in all these positions. They come in to the period with a certain number of reserves, and they get interest on reserves, and then they choose a new reserve position. They get interest on their Fed funds lending and choose their new lending. And basically all these changes are going to make up their cash flow. One key piece in these cash flows is this last piece. So up to here, basically the capital structure choice of a bank would not be determined because we have a model so far in which bank debt deposits provide liquidity to households. And so banks like to issue these deposits. They have to pay low interest rates on them. But there's nothing that prevents them from going all the way. So to make this choice determinate, you need something to destroy Modigliani-Miller. And this is our assumption here, is that there's costs of leveraging that I'm going to talk now more about. So there will be costs of leveraging, which are hidden.
Just a clarification question. So what's the difference here between reserves and Fed fund lending?
Yes. So let me get to 2 slides. Give me 2 slides, and I will explain what they did. Basically, reserves is something that a bank can hold, can decide to hold, and then they can just make payments with these reserves. Fed funds lending, they have to borrow from another bank, and so there's an interest rate on that, on the borrowing, and there's going to be an interest rate on the lending as well. So they receive an interest rate when they lend.
So just the interest on reserve is the only policy variable, everything else is determined in opposite.
And the quantity of reserves is also is going to be in equilibrium. It's going to be a policy variable as well. So here's again this cash flow, and this is the piece that introduces these leverage costs. We're going to have C is just a function of, it depends on the collateral ratio. In fact, the inverse of the collateral ratio is leverage. What's the collateral ratio? It adds up all these assets, and we can put a weight on risky trees in terms of how these trees enter the collateral ratio divided by debt, and that's on the right-hand side. And so the inverse of that is leverage. So the function C introduces leverage costs that are increasing, and they're convex. So that banks, the more they leverage up, the costlier it is. And these are resource costs. Imagine these are costs that banks incur to convince the outside investors that they're going to pay back this debt. Yeah, you can. In a model with, we have a version of this model with shocks that hit banks so that they can go bankrupt. In that case, these costs arise endogenously with bankruptcy costs. Here, banks, because of these leverage costs, value assets as collateral because it drives down their leverage costs. So the more assets these banks have, the lower their leverage costs. And again, the more debt they want to do, the more costly it is because this cost function is convex. And so this goes back to your question about what's the difference between reserves and Fed funds lending and borrowing. So these banks will get hit by liquidity shocks. So they enter into the period with reserves and deposits. And then there's a shock that hits them. There's some amount of net funds that they have to send to another bank. So if Vladimir is the other bank and I get hit by a positive lambda, I'm going to send him funds. And so what he is experiencing is a negative lambda shock. And these shocks are IID across banks. So imagine this is the US banking system, then the average is 0, so these funds stay within the system. It's just a redistribution of these deposits. And there's an upper bound on these shocks. So there's a lambda upper bar that governs the highest possible shock that you can get as a bank. So there's a liquidity constraint that says, well, you have to be able to pay these other banks whatever withdrawal you're experiencing. And this liquidity constraint says you have to have enough reserves or you have to borrow from other banks in order to make this transfer to another bank. How does liquidity management then going to work in this model is banks are going to choose a liquidity ratio lambda, which is a ratio of how many reserves they have to the amount of deposits that they have. they choose this liquidity ratio, and there's going to be exposed if they're hit by a shock. They're only going to borrow if they don't have enough liquidity, because borrowing from another bank is costly, so they have to pay an interest on borrowing from other banks. And ex ante, in terms of thinking about how many reserves to hold, banks will be thinking about the liquidity benefit that they receive if they hold reserves and are then liquid, so they don't have to borrow from other banks.
Why do you separate Fed funds borrowing and lending? Just lend less, or?
So this may be an asset that you choose to put on your balance sheet because it provides collateral benefits. It lowers your cost of leverage. And Fed funds borrowing is something that provides liquidity if you run out. And in equilibrium,
They will have the same interest rate? They will offer the same interest rate?
Yeah. Yes, there's going to be an interest rate on Fed funds borrowing and lending, and the Fed funds market, it has to be in equilibrium. So the total amount of borrowing has to be equal to the total amount of lending between banks.
Is there an implicit assumption that during the horizon I cannot reduce my Fed funds lending? The relevant horizon for the liquidity constraint?
Yes. So this,
Access. So that's right. So
you cannot recall. Yeah.
Today you cannot access that when this shock hits.
Okay.
Yeah. If you lend to another bank, you can't recall that loan essentially within the day. Any questions about this?
So here the trade-off is between holding liquidity ex ante, which is costly,
Exactly.
or borrowing exposed when the contingency arises.
Exactly. That's how banks decide about their liquidity management.
Banks between lambda tilde and lambda bar will have like excess liquidity.
Yes.
Within
Well, it depends. Lambda tilde. It depends on whether you have. If you're a bank that has enough, so your excess liquidity is going to depend on your position in reserves. If you have a lot of reserves, you're going to have excess liquidity. If you receive a lambda tilde that is too large, you're going to have to borrow from somebody else, and then already you don't have any excess reserves anymore. The lambda bar is the maximum possible withdrawal shock that you can receive. So the distribution has an upper bound. So what's in equilibrium in this economy? The government sets a path of nominal liabilities for reserves, government debt, and it sets an interest rate on reserves. So these are the policy variables. And there's a budget constraint, so we do lump sum transfers so that the budget constraint is satisfied. And it also faces a leverage cost that depends on the total amount of debt, which is reserves plus government bonds, relative to some tax base. Markets clear, so markets for goods, reserves, overnight credit, and all the other assets clear. And what we're going to study is steady states of this model. So output is constant, and the growth rate of reserves and bonds will pin down inflation. We're going to then study unanticipated shocks, and because the model doesn't have rich dynamics, basically we're going to reach the new steady state within one period. So we have an unanticipated shock and immediately study what happens when we move to the next steady state. Sorry?
What are those shocks?
We're going to look at them in a second. We're going to explicitly look at various things that will happen in this economy and look at the effects. So what's going to happen in the steady state of this model? Banks will optimize. They're maximizing shareholder value, so they're maximizing the present value of these future cash flows, subject to their liquidity constraints, and they take into account their leverage costs. And so they choose all these positions in the balance sheet to equate marginal conditions. They equate the marginal cost of equity with the marginal benefits of holding assets to the marginal cost of debt. because of the linearity in the setup and because we don't have adjustment costs for equity, only two things are determinate. The ratio for the liquidity ratio, so reserves over deposits, and the collateral ratio, assets over debt. And all banks will choose the same two ratios in steady state. And so we can summarize the role of the payment system, of this banking system, by these two variables, the lambda, the liquidity ratio, and the collateral ratio. Then we can think about what determines the price level in this economy, so consumer prices. Basically, you have a quantity equation that says the nominal value of total output, Y, is equal to deposits. So this is the quantity equation, where this is not some outside money. It's inside money provided by banks that is used to make these transactions. And then I can write this as reserves over lambda, because lambda is reserves over deposits. I can just rewrite it this way. And so now you can see that the lambda, this liquidity ratio, is basically 1 over the money. The money multiplier is 1 over lambda. And so what are the key trade-offs in this model? This capital structure choice that banks make has to trade off the liquidity benefit of debt, because it provides liquidity to households in making payments, versus leverage costs. The more deposits they issue, the higher leverage cost they have. And then they have to think about, to the extent that they like holding assets because it provides them collateral benefits, that's going to generate a spread on these assets. So that's going to incorporate a collateral premium. And then the choice of reserves, the liquidity management, is going to trade off the liquidity benefits, as you said before, with basically the opportunity cost of holding reserves, which is the difference between a short-term interest rate and the interest on reserves. Those are going to be the key trade-offs for banks. So let me show you explicitly how one such, so there are many first-order conditions that I could show you. Let me show you one, which is the one for short bonds. So banks have to choose how many short bonds they hold. And so their calculation is always going to be of the same form. They will equate the return on equity, which in this model with risk-neutral households is just the discount factor of these households, the rate of discounting of these households. This is the return on equity. And so what's the return of holding a short bond? It's the real interest rate, so nominal minus inflation, plus a marginal benefit of holding this extra bond. And so what is this benefit, this collateral benefit? This looks pretty, it's derived from it's a little bit uglier to take a derivative basically of the C function, which gives you these leverage costs. And these marginal benefits are derived from this, directly from this leverage cost function. And the important feature of these marginal benefits is that if a bank has more collateral, a higher collateral ratio, so more assets to debt, this marginal benefit of adding another bond on their balance sheet is diminishing. This is the convexity of the leverage cost function that I was assuming. And banks will have to make a choice of this collateral ratio, and in particular, so they have this equation in mind, and if interest rates are lower here, because the return on equity is fixed, they will choose a lower collateral ratio. In particular, they will think about basically how to choose their leverage to maintain the same return on equity. And if the return on the asset that they invest in goes down, here I'm lowering the interest rate, what they have to do is increase leverage to maintain the same return on equity. And that means increasing leverage and lowering the collateral ratio. So you can already see that this first order condition here bakes in a tight relationship between collateral ratios and real interest rates, and they move together. This reminds you of intermediary asset pricing. This is not a standard Euler equation because it's priced by, these short bonds are priced by an intermediary that has leverage costs and so prices in a collateral benefit. Banks value these short bonds that they can buy more than households because households don't have leverage costs. And that leads to endogenous market segmentation in this model. So banks will hold the assets that they can buy. The households will perceive these assets as being too expensive and will not hold them. Let me show you another first-order condition, which is the one for reserves. What's the benefit of holding reserves? Well, banks get a return on reserves. This is the real interest on reserves, plus reserves provide, again, a collateral benefit, plus in the event that they run out of reserves, so that they experience a withdrawal shock that is larger than their liquidity ratio, they would have to borrow from another bank, which increases their leverage costs, which depends on their collateral ratio, so that's costly. So this is the first order condition for holding these reserves. You can already see the difference between these two, between choosing whether to hold bonds or whether to hold reserves, is basically these costs of having to borrow from another bank. And if you have a low collateral ratio, this is costly to do. And so the more collateral you have as a bank, the cheaper it is to borrow from another bank.
Selling assets was not an option to meet this requirement, the liquidity?
Sorry, so which assets?
Liquidity shocks?
Yes.
So you had M plus F and F, whatever the mind.
Yes.
You couldn't sell assets to officers?
Not within the small period, within the short period that this is taking place. You can then, over a longer period, sell assets and hold them as reserves, but not in the short run, basically. So there's, because I've introduced this upper bound on the maximum liquidity withdrawal or deposit withdrawal that banks can experience, there's going to be two regions for holding reserves. If a bank holds a liquidity ratio that is smaller than this upper bound, then reserves still give you positive benefits because it still may be possible that you run out of reserves. If you have a liquidity ratio that goes beyond this upper bound, the difference between the interest rate on short bonds and the interest rate on reserves has to be zero. And bonds and reserves at that point are going to be perfect substitutes because there's no more liquidity benefit of holding reserves. You already have enough reserves.
All banks are identical, so there's no notion that some banks have a land that's high, some banks have a land.
Exactly. So they're all going to be choosing the same liquidity ratio and collateral ratio, and so we can study this steady state by just looking at these two ratios. On the x-axis, I'm going to put the liquidity ratio. On the y-axis, we put the collateral ratio. And so there's going to be a region in this picture with low liquidity ratio in which reserves are scarce. This is basically lambda upper bar, the upper possible limit of liquidity withdrawals. Here, reserves are still scarce. Here, they're abundant. Banks never borrow from other banks because they have enough reserves. So we're going to study graphically the equilibrium in this model within this graph. And so this steady state is going to be determined entirely by thinking about these two ratios. There's going to be we're going to put two curves in this graph. One is derived from the first order condition for reserves, which again shows you that here banks will want to hold reserves, and if they don't hold enough reserves, they're going to face this cost of borrowing from other banks that depend on the liquidity ratio. And so there's an interaction between choosing a collateral ratio and choosing how many reserves to hold. And so one of the two curves is going to answer the question, how much collateral is optimal for a given liquidity ratio that you choose? And so what's the connection between the two? If you have a low collateral ratio, if you have low assets to debt, then your costs of overnight borrowing are high. And then you choose to ex ante choose to hold a lot of reserves because you don't want to get into the situation where you have to borrow from another bank. I can say this equivalently, if your liquidity ratio is high, you have a lot of reserves, then this event happens less often. You run out of reserves less often, and then it's fine to have a low collateral ratio because you don't borrow from other banks very often. So it doesn't matter to you that if you do, it is expensive. And so this trade-off is going to lead to something that looks a lot like a money demand function for banks. For low liquidity ratios, banks choose high collateral ratios. And if they hold higher and higher liquidity ratios, their collateral ratio won't drop any further. So this looks like a liquidity trap, essentially. Initially, how much money banks hold depends on their collateral ratio, which we know from the first order condition for short bonds is intimately related to the real interest rate. And so for high real interest rates, banks choose low reserve holdings. And if interest rates go down, they choose higher reserve holdings. And so this is this graph. And then I need another curve to cut this curve. There's going to be a balance sheet relationship between the liquidity ratio and the collateral ratio because this has basically reserves over deposits, which is a form of debt, and the collateral ratio is just all the assets over all the debt. And so I can ask how much liquidity should banks hold given the other collateral that they have. And this curve is going to slope up. The more collateral they have, they're going to choose more liquidity. And so where these two curves cut is going to be the steady state, essentially. These two concepts are going to collapse. You already see the positive relationship if you think about a narrow bank that doesn't have anything else than reserves. Then the liquidity ratio of that bank will be equal to the collateral ratio, because there's nothing else in its balance sheet. And this curve, I'm going to run out of time, so I'll say this curve is going to depend on, the slope of this curve is going to depend on how much, what the fraction is of assets that banks have that are nominally denominated. And so the more they have, the more nominal assets banks have, the steeper is this curve. So we can determine an equilibrium and then think about the determination of the price level by looking at the quantity equation and think about 1 over lambda, which is on the x-axis. That's a money multiplier. So let me briefly talk about two things. So there are one is how policy works in the setup, and then so far I've only shown you a model with goods trading. What happens to this model when you also introduce asset trading? So first, how does monetary policy work in this model? Suppose the Fed wants to tighten money, and one way to do this is to sell bonds to banks and get their reserves in exchange for reserves. What that does is it leaves the collateral of banks unchanged, but it lowers their liquidity holdings, their reserve holdings. That shifts this capital structure curve to the left. And in equilibrium, what happens is that banks now have lower reserves. They have to borrow from other banks more often. That's costly, and so they endogenously choose to hold higher collateral ratios. That increases the real interest rate. What happens to inflation? Well, this is tighter money, so reserves are being sucked out of the system. You can see that the steady state liquidity ratio falls, so the money multiplier goes up. So it's not immediately clear from this picture, but you can study this and see that this policy is deflationary. And the financial structure is going to matter for how far left you move. And I will leave it. One determinant factor for this is netting in financial markets. Let me say that there's another way of increasing, pushing up real interest rates, which is to increase the interest rate on reserves. That shifts up this money demand function. Before we were shifting left the capital structure curve, now I'm shifting up the money demand function, and it leads to similar deflationary, it's also deflationary, but it shifts up liquidity holdings of banks. Because they're now, think of interest on reserves basically works like making it cheaper for banks to produce inside money, and that's like lowering a tax on their production. And so there are these two ways in this model of increasing interest rates, real interest rates. Let me briefly mention that there's the second big component in this model is asset trading. And so we wanted to have active traders that trade in trees and that households have equity in. And so these traders will trade trees and also hold bank deposits. So they will need bank deposits to make payments for buying and selling trees. And what this does is even these traders, they wake up. We think about these institutional asset traders as agents that get preference shocks, and they like a particular tree more than others, and they want to buy that tree. To buy that tree, they need deposits, and they also get some intraday credit that depends on some parameter. And so this parameter gamma that translates how much intraday credit these traders get given their initial deposits is going to determine how much money they need to make these asset trades. So depending on the interest rate on these deposits, that's going to govern how much asset trading these institutional investors make, because it determines their opportunity cost of holding these assets. And so these asset trades will suck up money out of the consumption market into the asset market and will inflate asset prices of these of these institutional investors. I'm getting signs, so you please ask questions, especially about asset trading.
Very good.
Yes.
Okay, thank you, Monika. We have a few minutes for questions. Someone has to ask something because
Otherwise, I'm going to go on and talk about asset trading.
Questions, comments?
I wanted to know
Yes.
what's the role of the assumption that I cannot sell my federal funds lending quickly. How will it change if I don't do that assumption? I mean, it might be realistic depending on the horizon in which you are analyzing the data, but does it matter?
So we think about this as a model of days, essentially. So it's a very short period. And the idea here is that there are certain assets that provide households liquidity benefits and banks liquidity benefits. And so when the bank has the actual reserves sitting at the bank, that's liquid because they can immediately use them for payments. They can also borrow from others, but what they cannot do, I cannot recall basically the Fed funds loan. Yes.
You cannot do that.
Yes, that's the idea.
It's more a question about the model.
Yes.
If I remove that assumption, how will the results change? Is there any, does it matter? Because then the results of monetary policy also depend on the horizon at which monetary policy is operating. So that's what I would like to know. If I look at an horizon in which, or it's just irrelevant for any result.
So the way I think about this is that basically reserves are the medium of exchange between banks. And if you allow banks to pay with any other asset, then you quickly have to think about whether the other assets, if there's no liquidity benefits from holding reserves, then that from the first order condition of the banks will immediately equate the interest on reserves with other interest rates because they can't go there's no benefit out of holding reserves. And so that's what would change in this model. So you would always be at an equilibrium in which interest rates would be mechanically linked to the interest on reserves.
So basically, we can understand that the abundant regime as a very short-run effect of monetary policy. Because
yes, or even, yes.
Not the amount,
Yes.
the scarce regime has
yes.
a very short run, because once you can treat the others, you will always be in abundant on average, or
or the equilibrium interest rates would look like in the abundant reserve regime, but the reserve holdings would be lower. So I can have an equilibrium in the scarce reserve regime. I can have banks that don't have high liquidity ratios, so they hold very little reserves, but the interest rate, equilibrium interest rates, are not all equal to the interest on reserves. And so to the extent that in financial markets you see, for example, in the US before the financial crisis, the Fed funds rate was above the interest rate on reserves. To understand that regime, there has to be some liquidity benefit for holding reserves for banks, and that's what this does.
I thought it was a nice model, giving micro foundations for liquidity. Now, my question is, if one cares only about aggregate outcomes and obviously policy interventions or whatever, but why? How is maybe you haven't had time to show us these results, but is there any sense in which some implications would differ from, say, a classical monetary model with a demand for money that comes from, some Bono-Tobin structure or something like that, in which I guess you would need some interest paid on money in order to have more of a match with your framework. But in terms of policy implications, are there any differential implications that we should be aware of, or any surprising results?
Yes, I would say, so the key thing about so we view this as sort of a module that can be built into many modules. The key feature of it is that it says that, so compared to a typical framework for studying monetary policy, is that there exists no short-term asset that does not have a convenience to it. Because so there is deposits, they have a liquidity benefit for the households, and then there's the short bonds, and Monika showed you Euler equation. The standard Euler equation does not hold because those are all held by the banks in order to produce the deposits for the households. Okay, and then policy transmission has to take into account that in all the Euler equations for short assets have wages in them, and so that's how it would matter. That all policy transmission must take into account how does the wage change, how does the convenience yield change.
It would be useful, I think, to compare it to a benchmark framework, which isn't
yes.
structured.
So we are in fact working on what happens if we take this module, put it in a standard, otherwise standard new Keynesian setup. What happens to
compare it with the usual
demand
for money.
Precisely. Yeah, that's on the agenda.